All right, so we got about 10 minutes to the bottom of the hour. So far as economic data out this week, nothing too pressing. We do have retail sales. We have producer price index as well. In my opinion, none of those carry the same amount of anticipation or weighting as did last week's consumer price index. Look, if the CPI number, which did come in hotter than economists were expected, if that didn't upend the equity market trend, producer prices index is not going to do so. Retail sales are not going to do so either. In terms of retail sales, that's the monthly data that we're going to get out of the Census Bureau. But just tracking Redbook index, which is delivered every week. This is a weekly snapshot of about 9,000 retail chains across the United States. And what we can see is just an acceleration in the year over year. The bar chart is a year over year snapshot, but the data is delivered weekly. Every week we get this data on annualized or year over year retail sales. Again, you can scroll down, you get the definition. It's about 80% equivalent to the Census Bureau's release that comes out every month. 9,000 plus stores. But again, for those who were expecting or anticipating a slowdown in retail sales, that's not necessarily what we're seeing. We're seeing steady progress, or at least sustained levels. This will differ, of course. This is not your one-to-one when it comes to what we're going to get out of the Census Bureau this week. But I still do anticipate very outsized gains in monthly retail sales. Will it meet expectations, and what the revisions are remain to be seen. This week is expected to be a down week. Why? For the S&P 500 at the very least. Why? So as some of you might have seen me tweet out over the weekend, statistically, going back 20 years now, this is not a good week. This was in Larry Williams, who studies the seasonality of markets. But this is going back the last 22 occasions. This particular week, where you basically have only 8 trading days left for June, only 8 trading days left in June. Only one time was the market higher over the last 22 years, starting from the 8th day left in trading for June. 21 times the market was down. Only one time it was up. Anybody guess what year that one time was? Chat box me. Anybody guess? Good morning, everybody. All right, let's see if we got a winner. Drum roll. No, no. So far, no winners. 2014. That's it. 2014. Now somebody put because that's a good question. And that's what I wanted to find out. Like, what made 2014 the year? Now, superficial, right? This will be just superficial, top of the dome kind of response. 1842. Nice, Rick. Remember the last time that we had 3 consecutive years of double-digit gains in the S&P 500. When did it start? 2012. 2013. The final year of that 3-year streak of double-digit gains, 2014. Where are we, folks? 2019, S&P 500 delivered a 31% total return. 2020, S&P 500 delivered a greater than 16% total return. This is year 3. Again, it's the last year of the 3-year streak, if it comes to fruition, of course. And that's, again, as I said, superficial, top of the dome. I would rather assess the various breadth, differences in the market. Or I would go to 2014 and I would look at, well, how many stocks were trading above the 50-day moving average? How many stocks were trading above the 200-day moving average? Did that play a role in why 2014 was the outlier year where the market was actually up when we had 8 trading days left? It was the only time. Now, I've done the 50-day. Like, I came in today having already done my homework, and quite frankly, the 50-day didn't tell us anything. 2002, market was down in this particular week. 50-day was not above 50%. 50% of stocks were not above their 50-day moving average within the S&P 500, and the market finished lower into the month end. Down, 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 almost every single time. 2011 was up slightly. It was, basically inconsequential. So what we'll do is we'll go to the charts, S&P. And we'll establish our dates here. Range, select range. That's already, nope, okay. Let's go to 2014. Let's go to 2014. Thank you. No, it didn't work. Why didn't it work? It's going slow. That's the problem. Okay. June 2014. We'll start on the 2nd. June 2014. Carried through to the end of the month. And so here we were on the 18th. So we had 1, 2, 3, 4, 5. Now we would start actually 1, 2, 3, 4, 5, 6, 7, 8. So we did go higher, and nicely higher at that. We had a red candle, but finished flat from there. So we were not down, and on the whole, we were up. So here's the key here is the probabilities, right? That's really what it comes down to, the probabilities. This is a quant study from Larry Williams that basically says, there's a greater than 90% chance the market will be down this week. Again, this week is usually monthly options expiration week because it falls in the 3rd week of the month, which is usually the monthly options expiration week. We're also going to get some early month end and quarter end rebalancing. Remember, this is the end of the quarter as well. Q2 ends June 30th. So there are a lot of mitigating factors to support rebalancing and profit taking towards the end of the quarter that could possibly, play here in this month. What also typically happens in June is a regularly scheduled FOMC meeting. It's not always in the third week of the month, but it is typically around the middle of the month to late month. Like, that is a number of factors that do usually facilitate downside pressure in any given month. It just so happens that these collide: quarter end, month end, FOMC meeting, monthly expirations, so on and so forth. Now, kind of want to leap forward here. S&P 500 June performance. So there's more. So here's the actual seasonality chart, which we've showed in the past. But here's just, a valid look at it. After the middle of the month, we pretty much take a dive. And it's not just the S&P 500. It's most everything. Now, we do tend to ramp higher into the very end of the month. These are trading days, not the calendar days. This is the trading days. Trading day number 1 of the month, number 2 of the month, so on and so forth, not the calendar days. So again, we do typically see that as well. This goes all the way back to 2000, so last 20 years. So if that's not good enough for you, here's another reason to expect. The whole of June is usually down. The whole of June, going back to 1950, is usually down with a negative 0.6% return. So it's not like you're going to get slaughtered here in the month of June. That's not what I'm saying. What I am saying is post-election years, which is the year we're in. Last year was the election year. This is the post-election year. Dating back to 1950, the post-election year for the month of June is usually a negative month as well. Like, we got nothing working for us here in this week, let alone the month of June. Post-election years. But when the S&P 500 is up year to date through May, greater than 10%, but less than 15%, which it was, right? Here's May, so that worked. 2 weeks later, which takes us through the first 2 weeks of June, market is typically positive 87% of the time with a 1% return. I think we're actually up a little more than that. We can obviously go to the tape. To today. And so the market, wow, no way. We're up 1%, 1.04% from that date, given the parameters of this study. Up greater than 10%. We were up 11% to end May, or year to date at the end of May, but we were down, we were up less than 15%. And the average return is 1.15%. We did 1.04%. This is why I say you got to know the data. Almost perfect, right? However, a month later, not as good. Average returns there. So that would take us to the end of this month. It could go either way, basically. It could go either way. 1, 2, 3, 4 down months. The big one was 1950, 1961. In the modern era, not a whole lot of occurrences, quite frankly. To be up this much already year to date, not a lot of occurrences. Last time it happened was 2013. So it doesn't happen too often. But this does not exactly speak well for the back half of this particular month. 1 month later, only up on average 0.46%. So that would take us to the end of June, which would essentially possibly see us, down here this week, maybe knocking off half of the gains that we have on the month. We're up a little more than 1%, knock off half of that. And maybe we do end the month, only up slightly. Again, it's just about the probabilities, knowing the seasonality. Last but not least, again, just going back to 2002, the market is typically down 0.5%. This is not a post-election. This is just every year since 2002. An average decline in the month of June of 0.5%. It's up 60% of the time, meaning from 2002, usually the market is higher, but there must have been some nasty years in there to get a negative average return. Things get better for the month of July, as you can see, up nearly 68% of the time with a 1.3% gain. So if there is weakness here this week into month end, into quarter end, the data also suggests it's a buying opportunity. July is typically a better month for the S&P 500. And it's typically an even better month for, as we've checked out in the past, the NASDAQ. NASDAQ has been higher since 2014. No, I'm sorry. What was it? 2008. Yeah, since 2008, the NASDAQ has been up every single July since 2008. Every single July. So just some seasonality to consider here, folks. All right, Finom Group members, we took our profit on our latest Apple trade. Some notes here from Mike Wilson of the Morgan Stanley team. Got his full report here. We'll go out on site tomorrow. I also have the latest from JP Morgan. It's a pretty good report here. Some good points about tapering. You can see it in the activity feed also at phenomgroup.com. I just put up, 4 pages. I think, in terms of looking at tapering, again, it doesn't matter which firm is reporting, the facts are the facts. 6 months before tapering or a tightening cycle, technology doesn't do so well. Financials do great. Healthcare does great. Growth, oddly enough, cyclicals versus defensive, and value versus growth. Value outperforms growth. Cyclicals versus defensives. Energy not supposed to do so well 6 months before, but it has done very well. Industrials do well. Discretionary does well. Tapering announcement, from the actual announcement to the tapering implementation. Energy doesn't do so well, which was noted in Tom Lee of Fundstrat's report recently. Materials start to do better. Industrials do even better. Discretionary, pretty flat, but still does well. Staples suck. Staples just suck. Healthcare continues to do well, but look at information technology stocks. They start to really climb. And they just keep going. 6 months after tapering begins, like the actual beginning of it. This is just, we're going to taper. This is the actual beginning of tapering, and 6 months after. 6 to 12 months later, again, technology does well, healthcare does well. This is growth. Healthcare, technology, that's growth. They do well under a tapering regime or a tightening regime. So, top 4 pages. You guys tell me which one you want to go out, and I'll send that. You want the JP Morgan on site tomorrow, or you want the Morgan Stanley? There's not a whole lot here in the way of Morgan Stanley. It's bearish. And beyond that, they basically just reiterate, we're mid-cycle, certain aspects of inflation are going to prove transitory. Others are going to remain elevated, but we may be at peaking CPI levels, consumer price levels. Lumber prices continued to fall on Friday, lowest level, below 1100 now. Again, we're expecting this to get into the 800s, but I don't foresee anything below 400 for the foreseeable future. I think this is one of those products. This is one of those inputs. These are, one of the commodity inputs that will transition into a higher price regime going forward. But it won't be, the 16, the 15, even the above $1,000 prices per plank. That's not what it's going to be. It's going to come below. It's probably going to hover between, between 500 and 800 for a number of years. Again, just depending on demand, the macro environment, so on and so forth. But, just in looking at the longer term chart, we're essentially just looking to basically cut off this head right here, but remain, in this area, $500 to $800 for a number of years. And again, where we are, between that $800 and $500, extremes is dependent on the whole macro environment and, economic climate, if you will. All right, so retail sales due out this week, producer price index due out this week, covered those. It's about expectations. I just want everybody to have appropriate expectations. It helps you, day to day. When you feel better, you don't act, irrationally or emotionally to the market whipsaws or price fluctuations. All right, looking at the market, we got about 45 minutes till we open. We're well off, the best levels of futures here this morning. NASDAQ futures at their height were up almost 50 points. ES minis were up about 5. So we've definitely come off those levels. The VIX is up 27 cents. Just keep in mind that it is Monday. We have automatic weekly hedging activity that takes place amongst portfolio and hedge fund managers on Mondays. They're usually hedging between 2 and 3% of their long equity market exposure. It's automatic. It's part of the reason the VIX is up through the morning hours on Mondays. The other part is just the VIX resetting from lower bids the previous Friday in the options market. In all, reality, the VIX is down about 3 cents right now. That's it. If you do the calculations, if you look at the COT report, you can make the calculation. The VIX is actually down, absent the reset, and even with the weekly hedging activity. All right, so where are we now? Apple, some of the big cap stocks here. Again, just speaking from last week's abrupt, I don't know, is it 180 or 360 when people make that dramatic turn? I always get confused with that. It's a physics thing. But Tom Lee of Fundstrat on CNBC, last Friday, and we have the report up on site at phenomgroup.com. If you haven't read it already, do check it out for all of our members, contributor, premium, and mastermind options trading members. I posted it out there on Sunday, and it basically goes through, why he all of a sudden, after weeks upon weeks upon weeks saying, you need to be sellers into any strength within tech, any strength in the mega cap growth names, any strength in FANG, you should be selling. And then all of a sudden on Friday, nope, U-turn. And he says that is likely going to drive the market. Those areas of the market are likely what is going to drive his price target of 4,400 mid-year. So now Tom Lee's had a pretty darn good track record of late, even, maybe going back 2 to 3 years. He's been the high man on Wall Street so far as his projections, his predictions. So if there was one thing going for the guy here, for the market, I should say, into the end of the month, the end of the quarter for the S&P 500, is that he's reiterating his $4,400 price target, upgrading the mega cap name. So, quite frankly, upgrading FANG, I should say. If the market is going to get to that 4,400 level, this is the way it's going to be done. I said it a month ago when he came out with that $4,400 price target. I said, wait a second, breadth is pretty strong. We had the percentage of stocks trading above the 50-day, 200-day moving average, 90% of stocks. And above 80% were, trading above their 50-day moving average. It's a really strong breadth. And at the time, we were more than 200 points away from that. Like, how much stronger could breadth get? And that was when, we were still seeing weakness in the mega cap names. So if you just kind of think about it from that perspective, breadth that was so strong a month ago, here he is with a $4,400 price target. I mean, you would have to expect things to get not just frothy, but at that point, somewhat euphoric. My point was that there wasn't really a probability that we could get to 4,400 without FANG, without the mega cap names supporting, the existing breadth in the market. And so finally he comes around and says, yeah, maybe you're right, Seth. Obviously he wasn't talking to me, but it's just, you can feel these things. And that's the whole point of focusing on market breadth, is being able to feel, what's possible and what's probable and what's improbable from these analysts, and strategists' suggestions about where the market is going. This is the S&P 500. Stocks above their 50-day moving average, which has slowly come lower here over the last month. Had a bit of a hook to the upside there on Thursday, Friday. But we're not where we were when he came out. This is where we were when he came out with that $4,400 price target on the S&P. And I was saying, wait a second. We were about, here we were, just under 4,200 on the S&P. How are we going to get to 4,400 when breadth is already this strong? It doesn't make a lot of sense. Could we move up to these levels with breadth? Yeah, but that might be worth 100 points. So 4180 to 4280, I get it. But, you'd have to get like 100% of stocks trading above their 50-day moving average to get, to his price target at this time. And again, that's why I said his price target didn't make any sense. If you're telling people to sell FANG, to sell technology, the most heavily weighted sector in the S&P 500, when breadth is already this strong, how are we supposed to get to 4,400? That's the calculus, folks. Coming into this week, where are we with, our sector ETF weightings in the S&P 500 now? 26.63% in information technology. To my point, how are we going to get there without information technology, without FANG? Given that breadth was already very, very darn good when he said 4,400 here, just before May, even, just after May, above 85%. Not to beat a dead horse. We don't need to do that. I do want to see where we are with respect to the percentage of stocks trading above their 200-day moving average. Still very healthy, right at around 90%. We've been here for a very long time. The 200-day moving average measures long-term breadth. Long-term breadth. To stay at these levels to stay at these levels, you can really only have minor dips. Minor dips with quick, buy the dip investors bidding it back up really quickly. And that is exactly what has happened here. Every dip, the one that we saw in January, 4.5%, got bought back within a week. Actually, the first 5 trading days of February, up, 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 up. First 5 trading days of February. 5 days in a row, the market was higher. Speaking of 5 days in a row, well, speaking of 6 days in a row, actually. Here's the NASDAQ. We've been asking for follow through. Here's the NASDAQ 100, the triple Qs. We've been talking about where's the follow through? Where's the follow through? Well, we're getting it now, folks. We're getting it now. As of Friday's close, 1, 2, 3, 4, 5, 6 up days in a row for the NASDAQ. Data. Up 6 days in a row. The last 5 years, it's happened 17 times. Last 5 years, it's happened 17 times. The NASDAQ closed higher within the next 5 days in 16 out of 17 occasions. This is a buy the dip, stat. It basically tells you 5 days later, after we've closed up 6 days in a row, we can come down here tomorrow, today, 3 days, 4 days later. But more than likely, we're going to be higher than this starting point 5 days later. The average gain, 1.1%. So on average, we should anticipate the high probability of the NASDAQ being up at least 1.1% 5 days from Friday, which is this Friday. Also everybody knows what today is, right? With respect to POMO. You guys know the POMO day we're dealing with here today, right? Chat box it for some of our newer folks. Let's see what we got. POMO. Where are you? There we go. This is usually also not a good day with respect to POMO. What does POMO stand for? Permanent Open Market Operations. This is essentially the Fed's schedule of QE purchases, quantitative easing, on a daily basis. Come on. There we go. So today's the 14th, and 12.425 billion is what the Fed will be purchasing in Treasury coupons today, and it starts at 10:10, finishes at 10:30. On this day, only 7 times now, 7 times out of 26, has the S&P 500 finished in the green or flat. 7 out of 26, green or flat. Not usually a good day for the market. Probabilities are that the market finishes red on this particular day. Why? There's any number of reasons that people have offered, including myself. The belief that institutional investors like the perceived increase in market liquidity. And so they use that to sell into. I've got no hard, evidence to support that. But, just in knowing how institutions work and looking for that best price, more liquidity usually offers that best price. So we'll see. We'll see how this plays out, but those are the stats, folks. Again, lean into the probabilities. If we get a dip here today, that might be an opportunity for us to put capital to work. We've already collected our profits on Apple. Maybe we can purchase that again as it dips. We're starting to ramp up, how many completed trades we've had in Apple this year, and especially more recently, I think 3 within the last 3 weeks. selling and buying at lower prices. That's all we're looking to do. Sell high, buy it back low, core holding intact, time and time and time again. Any questions as we progress here through the morning? Just let me know. Again, now we've turned futures into the red here this morning. So as always, futures are not necessarily a good indication of what we'll actually see through the first order of trading known as order flow. But, keep an eye on that 10 o'clock time frame, 10:10 to 10:30, see what the market does. Work this into your plan, folks. It's probabilities. Work it into your trading plan here today. I would be of the opinion it's best to wait. I'm always of the opinion it's better to wait until after order flow. Having said that, your game plan is about executions. And if the price if the price entry is achieved based on your plan for that stock or for that ETF, execute. As long as, act on local price with a long-term thought process. All right, 26.63%, by the way, for the information technology sector weighting within the S&P 500 or SPDR S&P 500 index ETF is the highest we've seen in about 2 months now. And that's with this rally in the NASDAQ now up 6 days in a row. It's catching its wind. It's getting its weighting back. But where's it taking it from? So when we look at some of our performance ratio charts that we frequent, as we consistently look at value versus growth. So now, don't do that to me. I just want the current now. Just want the current. All right, let's kick you out and turn you back on. Make things simple for us. Hope everybody had a good weekend. I went to Sarasota with the family for the weekend, a little fun and sun. A friend of mine came down from Connecticut. His daughter Rose for her high school, and they had a tournament there. The national tournament is in Sarasota, so it was fun. I've never watched a rowing tournament. Switch this to solid thick. All right, so this is value versus growth. And again, value has been in a intermediate term uptrend. Found this peak here. And if we drew our, line of resistance, if you will, you can see this has been pretty clear resistance. And now it's turned lower again, broke below the 50-day moving average in this relative performance ratio. So as we've seen the NASDAQ, as we've seen FANG, as we've seen technology and the subcomponents of technology, right? Semiconductors, software, cloud computing, cybersecurity, as we've seen all of those come back to life here, and with the 6-day win streak for the NASDAQ, we've seen growth outperform value. Again, value is the first ticker. Growth is the second. So going up here, value is outperforming growth. Coming down here, growth is outperforming value. Can this continue? Remains to be seen. It's a fluid situation. I think it is highly dependent on what's going on with the Treasury market and the yield curve. All right, this morning, Europe is higher off of the best levels of the session. We had been up by about 0.25% on the DAX. It's also off of its lows of the session. Asia overnight, Hang Seng, that's kind of flat for the Hang Seng, but that's 2 days up in a row finally after it had 4 days down in a row. Nikkei, nice move there. Kospi, basically flat as well. Bonds this morning, we were flat pretty much all morning until recently. We got a little bit of a jolt to the upside here, but still well below 1.50 on that 10-year yield. Oil still moving higher, nicely above 71. We'll see what the day brings for the energy complex. Precious and industrial metals here, nice move to the downside on gold, down almost 2% on the session. Copper, this is about the lows on copper here today as well, as we see copper, lumber prices, a lot of materials have started to basically chop off their heads. Copper's now down just a little more than 10% year to date. We know lumber is down 32% year to date. I'm sorry, not year to date, since the highs. Forgive me, since the highs. Copper's down a good 10% since the highs. Lumber is down a little more than 30% since the highs. As said before, these prices will not be sustained. They will continue to move lower, not in a straight line, expect fits and starts, but they are doing as expected. Crypto space has been up here nicely, basically the highs of the day on Bitcoin. Dollar slightly lower here as well, but decently above 90. Had kind of a nice move last week to the upside. All right, so value is underperforming growth over the last week. A couple weeks, maybe even. What else? XLK. So technology versus financials, otherwise known as, growth versus cyclicals in that sense. And we've seen now technology, coming to life again here, trying to get above the 50-day moving average in this relative performance ratio. Technology has been in an intermediate ever since September. That was the peak. Same thing with growth and value and growth. It peaked in September, that ratio. Value has outperformed growth ever since. This ratio peaked in September also. Technology has underperformed financials since. And again, this is another way of looking at growth versus value, or cyclicals. Financials, retail, those are cyclicals. Materials, industrials are cyclicals. Chemicals are cyclicals. But, can it get above the 50-day moving average and recapture leadership? I mean, if you look at this from a longer term, time horizon, obviously, this intermediate term downtrend in technology versus financials is just that. And it's related to the reopening phase of the economy. Come on. There we go. I mean, this is a 4-year chart, and you can see, technology is outperforming financials, outperforming. This was obviously, COVID, major outperformance. It's normalizing. I'm of the opinion that technology will come back around to become leadership as we progress through the early cycle into the mid cycle, for this economic expansion cycle as a whole. It has to. There really is no other way. Technology holds the greatest composition of earnings in the S&P 500. It also holds the greatest free cash flow within the S&P 500. Like, there is no other way. I apologize. The only other way is if all of a sudden, in mass, all investors decide, free cash flow, that's not such a big deal. Earnings are not such a big deal. Like, come on, that's just not realistic. We're just in this particular nuance of the next economic expansion cycle that affords, financials and cyclicals to outperform technology, but it should prove short-lived. I'm not of the opinion, jumping around from sector to sector, trying to, catch rotations that have been frequent and fast is the ideal participation for investors. Like, it's all they talk about on CNBC, on Bloomberg. this sector this week, that sector next week, these couple of sectors, then that couple. Like, you don't want to get caught up in that. In my opinion, as an active trader, you'll do just as well buying the dips in sectors that are out of favor and selling the rips when they become in favor. But the sectors that I'm choosing from and that we've chosen from here in the trading room here this year has been technology, has been consumer staples, every now and then consumer discretionary. We're still looking in the context of, or through the context of where can value be found, not necessarily a value sector ETF, but just general value in the market, acting on local price weakness, but thinking long term. And that has worked out for us as active portfolio managers, buying the dips in TQQQ, buying the dips in Apple, buying the dips in other technology names, selling the rips. Recently bought TJ Maxx as one of our cyclicals, retail sector names. Had a quick trade on that a couple of weeks ago, recaptured it at a lower price. See what happens here today. Flat now on the ES minis, a little bit of a bump there on NASDAQ futures. Looks like we got a nice little bump there on the VIX, back above 16 here. And we'll see. There's going to be continued rotations. The FOMC meeting coming out here this week should prove interesting. Semiconductors, let us not forget. Semiconductors versus the S&P 500 itself. This relative performance ratio has also been in a downtrend. Semiconductors just weren't in favor. Let's change that back to a 1 year. We've been in a downtrend since February. Semiconductors ETF peaked on this relative performance ratio chart. So semiconductors versus the S&P 500 peaked here in February with the NASDAQ's first all-time high and just kept fading. Now, since this lower low, we've had a nice move above the 50-day moving average, kind of, back and forth, back and forth. We'll see what happens from here. But as I said before, as the technology has ramped with the yield curve and the 10-year yield moving lower. Most of you saw this chart within the weekly research report. We'll look at just the 1 year, and we dropped. Once we got, once the 10-year broke below that 1.50 level, that the floor just opened up like a vacuum that just sucked it down that much further. Got into the 1.43s with the 10-year yield last week before this, little bounce. But here in the yield curve, this was the lowest level. The spread between the 10-year treasury and the 2 years, the yield curve, and 1.38 had been that low here. 1.37. And when we broke below that, a vacuum opened up, and now we're 1.31 or 131 basis point spread between the 10-year and 2-year. And as this has happened, financials came under pressure, technology rose. Financials benefit from a steepening yield curve, which is why financials have outperformed basically since September of last year into the new year as we continue to steepen the yield curve. And recently has come under pressure. You've seen the big money center banks, JP Morgan, Wells Fargo, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, all see some weakness in their shares. And on a relative performance basis, weaker than technology stocks, FANG stocks, growth, healthcare stocks. Coming into this year, I had said, I think it will be very difficult to get better than between 175 and 185 basis point spread in the yield curve. We got up to, 1.59 at the height, 1.59. Now, I don't think this is just going to continue to drift lower. I think we'll chop around. I think there's potential for upside here back to the 1.59, if not a break above that. But people have been calling for greater than 200 basis point spread. And I just don't see that happening. Not from where we started in the 10-year yield. That seems very improbable. It's still in play. It's still, a work in progress. We'll see what happens going forward. All right. So one of the key, measures of breadth that we've also been looking at recently, just because it has been uptrending and got above 800 for the first time recently, is the NYSI, otherwise known as the New York Stock Exchange McClellan Summation Index, otherwise known as just the Summation Index. Again, this is another measure of exponential advanced decline line moving averages, but we're getting that much closer to 900. There's a big time study when it gets above 900 for the first time in 6 months. Good things tend to happen. And we're almost there, folks. Almost there. So keep an eye on that. NAMO to end last week, which is the NASDAQ, in terms of is the NASDAQ going to continue, with this trend, we look at breadth. The NASDAQ McClellan oscillator, again, another measure of the advanced decline line, did tick higher and still hovering at the best levels that we've seen since back here in February. The NASDAQ hit its all-time high at the end of April. At the end of April, 14,211. But even the NAMO wasn't as high as it is today. And just for simplistic purposes, we'll look at the actual NASDAQ advanced decline line. Still not at an all-time high, but it is, again, at its best levels since February. NASDAQ looks good underneath the hood and on the price, absolute price basis. Any questions? What did I do? Day, thank you. Okay. Let's see where we are. NASDAQ comes into today, 14,069. It can get to it can make an all-time high today. Obviously, we've seen more than 100 points on the NASDAQ as if it's a religion lately. But looks very strong. 14,211. Can it happen this week? Remains to be seen. We've only got one trading position on the board with respect to TQQQ in the 110s. So we got to get into the upper 111s to take our profit on that. So that still gives us time to possibly even buy at a lower price. Only slightly bid up right now. Again, futures are now relatively flat here. Dow futures actually lower. Let's see what else is in my tweet profile here this morning of interest, if anything. Yep, there's the NYSI we just looked at. Okay, here as well. Remember that the percentage of S&P 500 stocks trading above their 50-day moving average hit 90% of stocks on April 14th. So here's that study. What happens next to the S&P 500 when greater than 90% of stocks are above their 50-day moving average? It signaled again on April 14th. 1 month later, the S&P 500 was up 0.8%. So that was as of May 14th. We're in between, 1 month and 3 months. But as of today, so we're in the in-between time, 3 months later, we can expect a return based on the historical occurrences of 4.6%. How often is the market positive? 91% of the time. Only one time was it down. So 3 months later, as of today, what we want to know is where are we today? The S&P 500 is up 2.98% since the signal on 414. Up 2.98%. The 3-month average return is just over 4.5%, 94% positivity rate. So we should anticipate more upside. There's no guarantees. Obviously, we could have one of these red occurrences. But as I always say, you lean into the probabilities. You can't fear that this is going to be the time that it doesn't quite work out. The probabilities don't work out in your favor. The more often you use the quantitative data as part of your process and you lean into it with your positioning and trading regimen, more than likely you're going to perform well. It's when you start tinkering with it, not leaning into the probabilities. Well, it didn't work for me last time, so I'm not going to do it this time. And it didn't work for me this time when I didn't use it this time. So I'm going to go back to working, leaning into the probability. Like when you start doing that, you're already offsides. Just lean into the data as if it's your religion. Again, that's a lot of green. You're going to get your one-offs. They're going to happen. But the more you lean into it, the greater your probable outcomes are for a profit. All right. Got about 12 minutes to go. Now, they had Katie Stockton on this morning on CNBC. And I remember, when we were embarking upon the last NASDAQ and technology downturn of what wound up being an 8% pullback in the NASDAQ. And she was also on CNBC then. Fairlead Strategies founder says tech pullback will continue. And she put a target on there of about another 8%, she said. And the tech pullback did continue. But it was only for another couple percentage points, not like a whole 8 to 10%. And in replaying these, what I often say is it would be better if they approached, the production, the program in a different way, which is, don't worry about it going down another 8 to 10%. Worry about what you're doing in that environment. When prices get, when things are getting cheaper, should you be buying the dip or should you be lightening up on your positions? But none of that is really offered on CNBC in that sense when they have these programs and these strategists or analysts coming on. It's often something that's, not discussed. So we'll step back in time. This was her call, May 4th, 2021. And so if we look at the technology ETF, we'll bring it up. What did I say the date was? May 4th. All right, there we are. So on May 4th, a little bit of maybe a dead possum bounce here, but then it did go lower. Found its trough moment here. Down 1.79%, down 5.7%. Obviously, that's just 4 percentage points difference.
From the NASDAQ 100 and its tech constituents, but just today we saw a breakdown from the consolidation phase that had ensued. So the breakdown was associated with gaps down for both the NASDAQ 100 index and a lot of its sort of bigger constituents like Google. That gap down is probably of the breakaway nature because it occurred after a good strong up move. So that suggests that this pullback will continue. As mentioned, it does reflect a loss of short-term momentum intermediate term momentum isn't great either, and there is room to oversold territory. So we try to use support levels as a gauge of downside risk. And for the NASDAQ 100, it's about 8, maybe 9% below current levels, looking at previous lows and highs and also the 200-day moving average. Of course, a decline of that magnitude would be pretty significant and pretty painful, but we would see it as something that's corrective within the scope of the long-term uptrend, which of course had gotten very steep recently.
Yeah, 8 to 9% would certainly be more than many are expecting, I would think, Katie. What about some individual names there? You mentioned Google. What's that chart looking like?
So Google, as mentioned, gapped down, and this follows the gap up in response to earnings last week. So that gap down leaves what we call an island reversal pattern on the chart. It's a very short-term pattern, so the implications are only really for the next couple of weeks or so.
And just a heads up, it never got down here. Actually, this was the bottom. She literally called the bottom. Well, I mean, she came on the show asking for more downside based on this gap here, and it didn't have. This was literally the bottom on this program right here.
But it reflects a loss of upside momentum, kind of a last-ditch effort to push higher that then fails and leads to the closing of that earnings-driven gap. Now, it does support additional downside follow-through for Google or Alphabet. And for that one, the support is also about 7, maybe 8% below current levels. And if you look at the chart, you can see that would really just be a pullback to the breakout point. So we would view that as very healthy and something that's very likely to be met with buyers that felt like they missed that breakout.
So if you do want to shift, Katie, now to the groups that essentially work today, that do well cyclically when the economy does well, when rates go up, we saw strength in materials, financials, energy, industrials, healthcare. Which sectors or stocks look the best?
So with a pullback, if it does persist like we suspected might, naturally you'll probably see more defensive positioning. Or in the camp that 10-year treasury yields will see a so-called retest, kind of like the tech sector, but maybe not quite as dramatic. And with that, you tend to see interest grow in areas like REITs and
Wow. Like, how wrong can you be, right? I mean, all we've really seen is a downtrend in the 10-year yield. Right? I mean, we tried to get back up to even 1.65% on the 10-year yield, but that faded quickly. Utilities have been just atrocious. Real estate has done well, but it's done well all year until recently. Maybe the last couple of weeks, just some home builders come under pressure, and we have seen REITs come under pressure. But getting back to double tapping the highs on the 10-year never happened. Didn't even really get close to 1.78%. We didn't even really get over 1.7% during this time period. So just saying.
Utilities, selected areas within healthcare and consumer staples. So I would expect it to be a bit more defensive, but for that just to be short-lived. I think the more cyclical sectors will be more neutral in relative strength terms. So that means they're probably mixed, where there's some opportunities both on the upside and downside there. So you just have to take it by case-by-case basis.
Katie, are there any areas that you think look very vulnerable? I mean, 8% on the NASDAQ 100 is fairly vulnerable, but we talk a lot about the Teslas of this world, the art complex. Is the support levels for them further below the 8% kind of pullback level?
Yeah, I would say generally speaking, we're looking at either the 200-day moving averages or the March lows as initial support levels. So we'd have to look at them individually. We're looking for higher lows for the most part versus March, because that's really the nature of the so-called retest that is underway. I would highlight the semiconductor sector. I think everybody's noticed that it really lagged in April. And with that underperformance, the ratios looking at things like the SMHs versus the S&P 500, those ratios look pretty toppy. So it differentiates this current weakness in terms of short-term momentum and relative strength from past pullbacks. It does suggest it will be worse. It doesn't mean we have another 8-9% downside necessarily, but it would lead us to respect the short-term momentum, which, as mentioned, is still to the downside.
Shepard Smith here.
Just a lot of ouches, right? I mean, and again, we had half of her 8% more downside call in the technology sector, just half of it, 4% lower, not 8%. And here's a look at that Google chart, by the way. look at the 1 year because it shows the gap, if you will, that she was mentioning. Here it is right here. So we got down to here. Here's that gap from earnings. Boom. And all we did was, she literally called the bottom that day, anticipating it to come down here and basically fill this gap. But it did nothing of the sort. Just beautiful chart, riding that 50-day moving average, right? I mean, beautiful. It could find some corrective activity near term, but I think it has one more, move to the upside. If you look at, let's see where we are in Bollinger Bands. It's probably close. Yeah, it's getting close to the upper end of the Bollinger Band. And usually when you get outside of the upper Bollinger Band, you get some type of consolidation / correction. Did so here. It went sideways here. That kind of defied it. This chop here, eventually it did go down, but here outside, a little bit of down, sideways and down. Here outside and down. Here outside and down. So I expect a little bit more upside possibly for Google near term, and then just some consolidation. One of the reasons I also say that is because usually when you have this kind of a distance between, if we map it out a little bit here, you get this kind of, gap between the index and the 50-day moving average, usually get some kind of consolidation. There it is again, some consolidation. So, and we're need a little bit more to really give us, a good distance away from the 50-day moving average. It's just overextended and possibly needs to get to a 70 RSI. Right now, it still has a very strong RSI at 65. 70 and above is overheated, if you will. And I think that's kind of what the stock is calling for. But we'll see. That's just what the charts tell us. Again, the charts don't really predict the future. They just, you look at them long enough, you start to see patterns develop. But again, our pros. So, Katie Stockton on again here this morning. And, we'll check out what she said this morning. My point really when we go through these exercises is just opinions. Everybody's got opinions. Everybody's chart is perceived through their own experience and sometimes bias. Not all the times, but sometimes bias. These folks that come out on CNBC and Bloomberg, just dudes and gals with opinions. Dudes and gals with opinions. They're not foolproof. They're an expert to the extent that they make money at what they do as, certified market technicians or portfolio managers or analysts. It doesn't mean they're an expert. It doesn't necessarily mean they have, precision. They're just opinions. All right, dropping the mic here.